Good morning and welcome back, everyone, to the Schwab YouTube coaching channel for the Monday edition of Trader Talk in today's market. I am your host, Kevin Horner, joining you from Denver, Colorado today. Pleased to be joined by my friend, Mr. Jeffrey Abelos. Jeff, it's great to see you as always. Hope your Monday's shaping up well. How are you?
I'm doing wonderful. I don't know if this week is going to be as good as last week, Kevin. I got to have donuts, get this, 4 different days last week. Yeah, so I was feeling pretty great by Friday. Hopefully this week we'll live up to the expectations, but I'm very excited to be here. How are you doing, my friend?
I'm doing great. Thank you. Of course, you know what? It was an interesting finish last week. We finally seem to have a little bit of a drawdown, a pullback in the market, reacting to some of these headlines finally, which we seem to have been largely ignoring for the better part of the last few months. But we're going to look at all of that with you, of course. So this morning, we are joined today by Brent Moores in the chat. You can say hey to Brent. He's going to get to comments and questions that Jeffrey and I are unable to. We'll keep an eye on things, of course, though we want to make sure to try to bring those ideas, conversational topics into our discussion as well to try and help you out along the way. So thanks for being here, everybody. Make sure you're following us on X if you're not already doing so. Brent Moores, CS, and Kevin Horner, CS. And eventually, there's bound to be some Jeffrey Abelos on Twitter at some point, I would imagine, but he keeps denying it for the short run at least, so not just yet. And of course, make sure you're subscribed to the channel here so that you're always abreast and apprised of what we've got going on for you all week long. Now, with that, let's get to our disclosure so that we can get to what you all are here for, the chart. So, first of all, remember that our discussion is exclusively informational and educational. We do not make recommendations. We do not make endorsements for any approach to trading the market here. We do, however, discuss technical analysis, concepts, and strategies traders may choose to employ. And we do that as we look at the trends of the broader markets here. So we'll be dabbling and dropping those concepts and ideas into our discussion along the way. Key takeaway as it relates to technical analysis is to not base decisions exclusively off technicals. We think it can be part of your process, but not the entirety and sole part of that process. Additionally, if you are new here, our agenda largely remains the same. We do a top-down review of the markets here, so that means we start with our broadest indices, the S&P 500, then we move into the NASDAQ 100, the Russell 2000, probably hit up with our semiconductors, and then do a little review on sector analysis, where our leadership is coming from, where our laggers are showing up, and of course, stocks in the news. We got a few in there today for upgrades and downgrades as well. So Jeff, let's do as we always do. We're going to start us off with the S&P 500. Found that 50-day a couple of days last week, and yet holding it. So I'm constantly reminded that the days like Friday and Thursday may not feel fantastic, and yet if we simply step back from the day-to-day noise of the market, we're still seeing a 50-day moving average providing support here.
Yeah, and remember, everybody, the more times it hits that moving average, the stronger it is said to be. So the more times it hits off that, you get more people looking at it saying, hey, let's hold. If you're in the bullish camp, if you're in the bearish, you say, hey, let's break through that. But you're absolutely right, Kevin. We're holding on to that 50 period. And even today, you see us kind of hanging in to that orange 20-day simple moving average, trying our very best to hang on to this bull momentum. Kevin, real quick, I want to throw out a statistic. Yeah. I know I was on the show last month, and I talked about this. I want to revisit this. We were talking about the January effect, and as goes January, so goes the rest of the year is the saying that a lot of us remember. The math behind it is January's direction has correctly predicted the full year about 75% of the time. Now, this didn't happen. January is only up 1.4%, but excuse me, when January is up 5% or more, the year has never finished down. So we just missed out on that 5%, got 1.4. So overall, the math says 75% of the time we should see a positive year coming into the end of the year, Kevin. Whether that holds true, I have no idea. Past performance is no guarantee of future results, as you know, big guy.
That's the truth. But we do take all of these axioms and idioms of the market with a grain of salt, and we often remind ourselves that they are there for a reason, right? It's one of the things, you just called it out, the consistency of a moving average or a trend line providing support. The more it offers support, the more likely it is to be held. And I think one of those things, that a further one that we could utilize, one of those idioms, so to speak, is the longer the trend, the stronger the trend. trend. And I bring up the 5-year weekly on the S&P 500 as a brief reminder, noticing that we're still above that green 20-week moving average. So once more, if you are not the trader who pays attention day to day and is working to try to maybe mitigate the noise you hear from the market, then maybe you're monitoring the weekly view of the S&P. You're maybe making decisions based on a close under the green line, under the 20-week moving average, as opposed to something like the daily moving averages, Jeff. It can be a lot easier for someone who's a bit more casual about the market to simply step back and look at it on a broader long-term viewpoint. You don't have to do the day-to-day charts, do you?
Well said. You could also, too, take a big chunk and say, hey, with the largest chunk, I do long-term investing type of trading, if you will. So think I'm in something for more than 6 months. But then with a smaller portion, that I'm using for some plays. Let's see if I can get a stock at the right time, or maybe a position that works out well for the next 3 to 4 weeks. Think swing trading out there. So it's not an all or none game to the viewers out there that are saying, oh, I have to invest everything all at once or nothing at all. It's absolutely not true. You can break it into different buckets and you can make it happen.
It's a good reminder, Jeff. I'm giggling a little to myself as I see a little humor in the chat. It's all tied, of course, to your love of donuts and your preference to utilize the donut hole as your crystal ball, perhaps. Well, call out their expert. I found that to be great. Okay, Jeff, let's move off of the S&P. Let's see how the NASDAQ is doing here. We got a little bit of green. We're not overdoing the open because the pullback and the volatility we got Thursday, Friday was notable. And yet, Jeff, here we are, 50-day moving average even still. The other quick takeaway that I'm going to mention is the fact that we had some intraday, a nice big fat tail there on Thursday. We had really good weakness, and yet that got bought up quite well. And it happened at this ledge. Now, this level is right around 25,400. It'll be a little more evident on the daily, but I'm going to give you a chance to maybe speak to what you've been noticing about the NASDAQ 100, and then we'll drill into some hourly look here as well.
Yeah, well, I got a question coming from somebody. Does the January effect also pertain to the Dow and the Russell? I don't know. That's a really good question. I have not researched that. I've only looked at the S&P 500. So you're going to want to check that one out. One of the things that jumps out to me, Kevin, when I'm looking at the NASDAQ versus the S&P 500 is the NASDAQ isn't hitting new all-time highs. It did come back up and it tapped that level, but then it pulled back down, whereas you are seeing the S&P 500 continue to appreciate higher, along with you're seeing a draw out in breadth, meaning it's not just the top 4 or 5 companies that are driving the S&P 500 higher. It is a lot of other companies. So that is something to keep in mind. So as we're looking at the NASDAQ, Kevin, really good call out. I think also, and you have referred to this in the past, the Horner rule. Notice how it dropped below the 50 for 1 day, 2 days. All right. Some of us would have said, uh-oh, maybe I'm starting to get out of this trade. While others said, wait a second, I know 1 or 2 days is not enough for me to say this trend is broken. I'm going to wait for that 3rd day or maybe that 4th day. And if you did that, you would have been in a pretty good spot. But overall, those 2 lines, that orange and that white line, are starting to converge. I would generally say traders are looking for something coming up within the next month or 2 that might move this market, either saying we're going to break out in a bullish fashion or we're going to break down in a bearish fashion. What's happening right now? We're in the middle of earnings season, one of my favorite times of the year, Kevin. So could that be the catalyst that lifts it higher or drops it lower? Absolutely, but we'll have to wait and see. What are your thoughts?
Yeah, you're on the right path as far as I'm aware as well, Jeff. Obviously, we need catalysts for movement. Earnings can be that catalyst for us. I wanted to drill into the hourly bars, which is what I've got here, 1 hour over the last 20 days. And I'm just going to call out the level that we've kind of tested with the lows we just made. So you had the Thursday, the Thursday, Friday lows coincident with the lows from earlier of last week. So there's been a bit of action at this ledge. And I think that's the one that many in the shorter term are going to keep an eye on. Another application some of you short-termers might throw on here might be the volume profile. Let me see if I've got it loaded. I don't. So I'm going to add it real quick. And this can help to validate areas of potential support and resistance, but it's not going to, of course not. I'm looking at an NDX. It's not going to do that where I don't get volume, Kev. I know better than that. But one way to look at it. You might apply it if you were looking at this on maybe you're working with an equity that is maybe more or less tracks the NDX. You could utilize volume profile and see if it validates any of this areas of historical support over the short term. So this ledge at 25.4 seems to be pretty important for the NDX. We'll see if we get that bounce based on this here this morning. Jeff, we also, as you called out, you mentioned the movement in the S&P. The biggest reason, in all likelihood, for the S&P's continued price appreciation versus what we're seeing out of the NASDAQ is likely tied to the allocation of the S&P, where we have components invested in energy, materials, and staples, which on a year-to-date basis, let's sort year-to-date, energy, materials, staples. They're your big three. Jeff, it's not common that we get fantastic market returns when these are our leaders.
Yeah. This also ties into the 4-year presidential election cycle. So if you look back historically, a lot of you already know this. We've talked about this on previous shows. But year 2 is generally the weakest as well as the most volatile during that 4-year presidential election cycle, which is what we're in right now. So as we're seeing energy, materials, consumer staples, you may even see healthcare. It might even look for utilities to start showing up. Some of these more defensive plays tend to be the better performers in year 2 of the presidential election cycle. So, Kevin, it does seem to track that we are seeing some leading coming from these more defensive sectors.
Yeah, and it's not to suggest that we can't undergo a drawdown in technology while still doing broadly okay. We can have a positive S&P 500 return without the NASDAQ or the technology group having a great year, but it's unlikely to return like it did in, say, 23, 24, 25, when our combined, our aggregate move was like 70% over those 3 years. It is very unlikely that we get, a 20% SPX year. It's much more likely we get the standardized return, which, Jeff, I need to bring up. Historically, remember when we started learning about asset allocation and modeling towards long-term diversified portfolios, the goal was about 7 to 8% annualized over a long-term window of time, right? 10, 15, 20 years. And that's fallen away because of the recent action we've seen from the market. Traders and investors tend to get tied to what they've seen most recently and believe that that is going to be going on in perpetuity. And it's very, I think, helpful to be reminded it is not.
Yeah, because of recency bias. A lot of us remember what happened most recently. This is why you'll find some traders are skewing more towards exponential moving average versus simple moving average when they're doing more day trading or swing trading, because it gives more emphasis to the more recent events. So really good call out, Kevin.
Okay, well, I don't mind that. That's a great reminder, too. Just another little nugget of technical analysis that can change things a little bit. All right, now let's move on to our small caps. And of course, I saw a comment in here. We're absolutely going to get to your precious metals. I know we talked about it in depth on Thursday. We want to definitely do a little bit of a follow-up. Let's talk about the small caps, though, before we get there, Jeff. The pullback here looks like we came to that 2,600 ledge on the nose, basically filling the gap down to essentially the former highs now becoming potential support. It's too early in the day to probably validate it as such, but it's a starting spot, yes?
Yeah, absolutely. It's something to keep an eye on. And certainly, what are we looking for when we're doing a lot of trades? Support and resistance. In this case, you've got that break below the 20-period simple moving average, giving an uh-oh sign. But you do have that 26 call out that you just mentioned, Kevin. Really nice job. So traders are probably going to be trying to parse together as the earnings season comes along. You've got Amazon, AMD, a couple others that are reporting this week that could really move the market. That might give a little bit of an indication. Do we regain that 20, or do we drop below that? And then, Kevin, what happens if we do stay below that 20? I think for a lot of traders out there, that 50-period simple moving average is probably going to be top of mind.
I think so, too. You could even draw in a manual trend line here, perhaps, suggesting that we've got every reason to hold this, but it doesn't mean it has to. It just gives us a way to base our risk, right? Some traders under here would say, yeah, you're right. If it broke the green line, if it broke 2,600, we're apt to find the 50-day, and that's only 45 points away. So some investors, some traders would say, I'm comfortable. I'll stick with everything I've got down to the 50-day. And then if the 50-day gets violated, maybe I get 2, 3, 4 closes in a row. Then I'll look to reduce position size, whatever that is for you. The key is to be thinking about it before we get there so that you can make a decision live and in the moment without emotions. You've already kind of given yourself the framework or the playbook to take action, which I think is very, very important. Alternatively here, if we're going to mount a stand, the first time we're going to be feeling good about it is with a hold move, and that's over the high we made on Friday if Friday's action is our low. It's still too early to know, right? But if Friday's action is our low, then what we need to see is something through 2650 to the upside. A close over 2650 would give bulls the belief that we are back in potential gear to the upside. So an early potential signal on the Russell there. Okay,
Right. Good call.
Jeff. Let's talk. Okay, we're talking rates, so we need to talk rates if we're talking small caps. Let's look at what's happening with rates. The yields have been stubbornly holding. And I say stubbornly because everything that's happened since the break of the downtrend in terms of the yield has been bullish for yields. That's not ideal as it relates to the Russell, as it relates to some of our interest rate sensitive groups. And yet, Jeff, the Russell has actually managed to digest this move pretty effectively. It's very interesting to me that we are in potential bounce mode in yields and the Russell is still near highs.
Really good call out. And so what does that lead everybody to believe? Well, there's a deeper story happening beneath the surface. So what would you then do to figure that out? And Kevin, we can't go too far into this on the show, but what is the actual APR, the annual percentage rate, that most small businesses or small companies are working with, and then figuring out, okay, with that much, how much wiggle room do we have before something really starts to transpire and say, uh-oh. But yeah, really good call out. Rates are going up. I think that works well for a lot of us that are using the money market funds. Maybe we're sitting a little bit in cash and we've got a hold in there. Kevin, rates have never been my forte, so I'm curious, as you're looking at a chart like this, we've regained that 200 period simple moving average. Anything you're thinking that might play out over the next couple of weeks or months if this were to continue to hold, or any foresight on that?
I worry that a continuation of the yield climbing could continue to put pressure on small caps. I think that small caps would benefit, obviously, from a deeper pullback, but that means that investors have to be willing to buy up U.S. Treasuries, and right now they're not. There's some concern. They're selling U.S. Treasuries, and that's why yields have been climbing. And so the health of the economy might actually have something to do with this. Even if the administration is capable of, getting the Fed to act on its apparent mandate to lower yields, it doesn't mean it's going to happen. We've seen this play out previously, Jeff, where in advance of a decision, yields cratered, and then we get the rate cut and yields rally thereafter for months at a time. So we don't know, but I would say that a continuation of the uptrend is apt to be a bit of a headwind on the small caps. At some point, there will be diminishing returns. It just hasn't hit yet. So I think it's something we're going to have to continue to monitor here in this particular conversation. Otherwise, we put ourselves at risk. We have to keep an eye on it.
Yeah, good call out. Really good.
Okay, Jeff, let's see what's happening here with our semiconductors. We're going to check out the SOX. Okay, Jeff, that right now looks like a pretty standardized pullback here, doesn't it?
Sure. Yeah, you got the blow off hitting 83, 86 or so, and then coming back down, finding a little bit above that 20 simple moving average. Mm-hmm. Kevin, I'm curious, are you able to quickly add on a 10 period simple moving average? My thought is, as we were climbing up over the last month, yeah, there it is. So I think the market was really paying attention to that 10 period simple moving average as we were going ever the more higher. And as I mentioned earlier in the show, the more times it hits, the stronger it's said to be. That might be the moving average for this particular index that a lot of traders are looking at, as opposed to the 20 or the 50 right now. Now, I noticed you're doing a drawing real quick. What are you starting to see?
Well, that's just another area that, commonly, Jeff, one of the things I'm reminding traders about is we see these trend lines break when the dynamic trend line, the moving average, 10-day, 20-day,
Hmm.
whatever is the leading supporting trend line. When it breaks, it's not uncommon to find horizontal support.
Hmm.
What I was thinking was if we put them all back in there, notice how like the 20-day could easily bring you to the confluence of the 50 and horizontal support. So that's around
Yeah.
73.80, 73.75. And then I'm always trying to add in some additional confluence. So what about a Fibonacci move off of this big tail we got from November and see if it all
Good
lines
call
up? And
out.
so, that's kind of in a zone of right around 50%. And
Yeah.
really, and granted, that doesn't mean we have to do that now. However, the way that I might look at this, Jeff, and I think some traders might consider this would be, hey, with a close under the 20-day, there's every reason
Hmm.
to think we could see the 50-day and this horizontal support. And if nothing else, Jeff, that would give traders a reason for maybe lightening up on a close under the 20-day. Doesn't mean it has to do it. Doesn't mean that even a close would result in a drop to the 50-day, but it does increase the risk that you are apt to see the 50-day rather than going to new highs, at least on a close below the 20. That would be the first thought. But
Yeah.
what are your thoughts as it relates to all of that analysis, so to speak?
Well, I think it's an excellent insight. Really, I also like the call out of the Fibonacci, especially in these sideways trending markets. That ends up becoming more of your tool belt than a lot of other studies out there. So I really like that call. And this is a really good reminder for everybody. Hey, if you need an extra something to take a look at, check out the Fibonacci retracement, which is what Kevin threw up there. I will give a little bit of a caution, though, Kevin. What you don't want to do is get the confirmation bias creeping in where you're saying, well, all the stuff I normally see says I should get out of this trade. Maybe I should add the Fibonacci's in and find a reason to stick with this. So do be careful with that. You generally want to stick to about 4 or 5 studies that you use regularly and that you know really well, Kevin.
Could not agree more. I often say that studies like the Fibonacci's, your RSI's, your MACD, these are all clubs that should reside in your bag of trade, your trading golf bag, so to speak, right? But they're
Yeah.
not always going to be proper, and really we know that they're not going to work 100% of the time, which is kind of like my golf swing. Never does it work 100% of the time. So
You and me both.
with this in mind, I'm gonna have some where that club face opens a little bit and I end up slicing, and I'm gonna have some where I close it off and now I've hooked it, and inevitably I'm gonna make some mistakes. But the key is as you said, Jeff, I think very importantly, don't go looking for a bias to validate your viewpoint. Try and stay unemotional. Try and do it to the letter of the price action. It's often why you hear things that, like we say this, we bring these tools to the table, but often what happens to a trader is the longer they spend time trading the market, the more
Mhm.
likely they are to simplify the process and not
Yeah.
utilize 3, 4, 5 indicators along the way. They probably drill into 3, and 2 of them are the most common: price action and
Yeah.
volume. And there's nothing much more important than those 2 big ones. It's not uncommon to see a trader. I mean, you can count me amongst this group. After 30 years now, I'm basically falling back into the most comfortable process, and that is just price and volume with a couple of details here and there, nothing more. So try not to
Yeah.
overthink it, I think, is what we're getting at, Jeff. We can always do that.
Yeah.
It's easy to do as a trader, isn't it?
Oh yeah, and you have plenty of time to do it all throughout the entire trading day. Wait, should I do this? Am I making the right decision? All that creeps in. But really good insight, Kevin. Keep it simple, as Mark Idom used to say. Keep it simple, super trader.
That's right. KISST. Yes, keep it simple, trader. Okay, Jeff, we're going to talk about precious metals here because
Right.
I spoke on Thursday about this, and I'm going to give you guys a couple of reminders as I do it. Remember that futures trading, futures options trading involves substantial risk. It is not suitable for all of us as traders and investors. And in order to do so at Schwab, you do need to be approved to do so. So make sure you're going through all the requisite steps as it relates to trading futures at Schwab. You do need to be familiar with the disclosure statement as well. So make sure you're aware. Now, The reason we're talking gold and silver today, Jeff, is because there was what appears to have been a pretty significant blow off top. And I got lucky on Thursday of last week, which was the day we made the substantial move here, right? Got gold up to 5,600 and change. But gold and silver both experienced extreme volatility, likely tied more than anything to the FOMO trade, I think, Jeff, the fear of missing out. Yeah. And this is inevitable, and I do mean inevitable. When we get these big spikes to the upside with volume, volatility, enthusiasm, the belief is inevitably, oh, this is going to go on forever. I can absolutely crush this and do wonderfully. And yet traders do not consider the necessity of management for their trade. And that's why I felt it was imperative that we spoke to it. I'm really glad that I spoke to it on Thursday in particular. But Jeff, this unwind that we've seen in gold and as we will see momentarily in silver, it's not unexpected given the way that it had moved to the upside, is it?
Yeah, this is not a company, everybody. Remember, this is not an earnings play. This is almost turned into a meme stock type of experience for a lot of traders out there where they say, well, as long as somebody is willing to come in after me and buy at a higher price, I am going to hold on to this. What you end up seeing is as you get this exponential rise in something, you almost get a blow off that is inevitable. It has to happen because there is no foundational element that is driving these metals higher. You could say, well, wait a second, you've got gold in certain products, you've got silver in certain products, sure. But the growth that they had experienced was not in line with the fundamental use of those metals. And so as you're looking at gold here, Kevin, I love that you called this out on Thursday, and absolutely, I will take luck every day of the week. So the fact that you nailed that and timed that just right, pat yourself on the back, excellent job. But that big down candle, everybody sees that giant red candlestick right there. Very, very large area for concern for a lot of traders, and especially those who follow technical analysis saying, wait a second, candles aren't supposed to be double the amount that they normally are. What is going on? So let's talk to that. You notice it finding that 20-period simple moving average, even came down earlier today saying, hey, should we test that 50-period simple moving average? What does this mean for the bulls that are on the gold tip? You're most likely, based off of history and bubbles, this is going all the way back looking at tulips, what tends to happen in these situations, you have this big blow off, and then somebody starts coming back in, they say, wait a second, this isn't over. So you see this little rise. They usually refer to that as the bull trap. Oh, okay, good. This is my opportunity to get back in, and I'm going to go much higher than it was. And gosh, I just don't know if it's going to hit higher than 5,600 in the near term. But watch out for that. Kevin, I think a lot of traders out there who follow historical bubbles would not be surprised to see this come up a little bit more before coming back down to a reality. Now, whether that will happen or not, ultimately, as a lot of you know out there, I just have no idea.
Yeah, really, this is the reminder, right? Nobody knows what the next move's going to be. I didn't know what was coming on Thursday when I spoke about it, but I did know that there would be a way to manage the trade for those of you who've been profiting along the way, whether that's the 5-day moving average, the 10-day moving average, a trade below the low of the high day, and yet, you know what? Hopefully somebody somewhere looked at that conversation and was able to take some profits. We'll have to see if that 50-day or this ledge at 4,400 approximately on the price per ounce holds on gold there. You've seen something very similar here, though, Jeff, as it relates to silver. So we'll carry the conversation there. The silver move, basically the same thing, just a speedy unwind of these exceptional moves to the upside, which at the time didn't feel like it was going absolutely parabolic, but it has to be. Look, Jeff, we went from 90 to 121, 122 over 6 bars. It jumped 33% in a week. That is in a precious metal, Jeff. That is the kind of thing you don't get.
It's very rare. Usually, what a lot of folks look for is something very broad-based, moving up 100% in under a year. And that's certainly happening here with silver. So that big sell-up, I think, was anticipated by a lot of folks out there. It was just one of those, all right, who's going to be the first to show up and buy at the higher price? So you have that big blow-off. It's the largest since 1980. I think, if I remember the statistics on that one, Kevin, they said something like $5 trillion was lost in a single day because of that trade. check the math on that one. It's not great, I'm sure. But notice that silver is a little bit ahead of where gold may come to, finding that 50-period simple moving average as a potential support. Will that get back up above that 20-period simple moving average? I think a lot of traders are going to be out there looking for that. But ultimately, I just have to imagine for a lot of folks out there, they're saying, okay, this was the end of the trade that we were looking for, with a few people saying, wait a second, I've lost some money. I bought at the high. I want to get that movement up even more. They're going to have to watch out for that bull trap as it potentially comes over the next couple of days to weeks.
You're absolutely right. A pullback like this inevitably is going to bring in the late stage trader who says, oh, great, we finally got the pullback. I'm going to be able to buy in here and participate, and it's going to do exactly what it did for the last 6 months. But that's not necessarily the case. So inevitably, have your plan, stick to it, and try to go maybe a little slower if you believe that you're going to participate in what we saw recently. It's all just going to come back in, and again, we're going to see a similar rally. If you believe that, start small, you'll feel better about it. And if it continues and you're able to participate in that way, you can always add to something that's working already. There's nothing wrong with that. We should also briefly, and I do mean brief, Jeff, we're going to quickly touch on Bitcoin here. Looks like we've seen a bit of a breakdown, and it's notable. I'm going to remind you all that digital currencies, such as Bitcoin specifically, is highly volatile. They're not backed by any bank or government, of course. So these lack many of the regulations and consumer protections that many of us are familiar with and comfortable with. So just be aware of that as well. Now, Jeff, the key here, I think, is the fact that we've broken that range. I mean, there was 2-3 days above the range that I've drawn in, but ultimately with this big move over the last 2 days, this does not feel great for Bitcoin.
It's tough. Another thing that's happening out there, for those of you that aren't following along, MSTR is a company that's bought, I think, 712,000 Bitcoin. Their average price, as I understand, you're going to have to check on this, but my understanding is that their average price puts them at about 73,000 for Bitcoin. So anything below that, and they start losing money. Now, a lot of this stuff was bought with debt. So that's causing a lot of stir on some of the undersides of the Bitcoin community, saying, hey, what happens if Bitcoin starts to go below that 73,000 level? Will a sell-off be induced? Is MSTR going to eventually start releasing a bunch of shares, a bunch of coins to try to pay down whatever debt they have to hold on to this? I have no idea, but that is a little bit concerning for those of us out there who say, wait a second, that's a lot of Bitcoin in a single individual or in a single company. Could it be market moving? I would say most certainly that's something that a lot of traders are going to be looking at, Kevin. I noticed you got a chart up here. What are we looking at? What are some of the levels that you're seeing?
Well, I'm just seeing, unfortunately, a 52-week low is evidenced by today's intraday ledge there, 138. Not ideal. It's not alone, but you're absolutely right. This is a concern because it is a potential spiral effect, unfortunately, when you look at looking at strategy, because the majority of its business is now housed in a position in substantial amounts of Bitcoin, as you said. So if Bitcoin continues to break down, it's like a spiraling effect, right? Because if it continues to trade lower, strategy is going to be forced to sell, which will compound on itself and carry Bitcoin lower still. This is a really precarious spot, unfortunately, for Bitcoin. Now, we're still above the levels, as you called out. I think you said 73, 72 fits the story there.
I think, if I remember correctly,
That sounds about right. But today's low was pretty darn close. I mean, we're talking under 75. This stands out. So if this is something you're watching, just be aware there's a bit more risk here maybe than we had initially considered. And the conversation that was, of course, around strategy, doing so well. This is such a beautiful plan. It's just they're printing money. It's easy to do. It's obviously never going to change. Hopefully that reminds us that nothing is good in perpetuity, Jeff. That's easy to be reminded of in a time like this. Okay, Jeff, real quick, I wanted to make note of the fact that we're getting a pullback here in energy today. And I wanted to do this quickly because I want to get the stocks in the news. So energy pulling back, but it's still a good longer-term uptrend here in place. We're well above the 20-day. It might be the 10-day that requires a little bit of support opportunity here. We've been above it for a while, back to late December.
Yeah, potentially, right? And what is of notable happening here? Well, you get that big run up. It's only natural that something take a breath. Remember, these people are running marathons. They have to stop and get a drink of water every now and then. And I'm not saying that energy and that a lot of the oil that's driving the energy sector is going to be running a marathon for the bull side. But I don't think it's unnatural, Kevin, that we do see a little bit of a relaxation of this upward trend. Yeah. I like that you called out that 10-period directional moving average. EMA and SMA 10-period is probably in the same ballpark. So that level could be something that a lot of traders are going to be looking at in the move forward period. But I don't know that there is enough momentum to the downside to say that, hey, this trend is over, especially given that increase in the relative strength index that we see in the bottom of the chart. Watch out for that. A move higher without reclaiming that high could be expected. That's already in what they call the overbought territory. Doesn't necessarily mean that, yes, it is overbought and that it can't go any higher, but it's certainly a level that traders may be keeping in mind as we go forward for those in the momentum play camp.
Yeah, I think a lot of traders, Jeff, would look at that RSI move and call it validating of the breakout. And the fact that we're simply pulling back to currently a 10-day moving average, we'll see if it holds. But that would be perfectly appropriate and maybe for some in the short term, a comfortable entrance to energy, which has, by the way, broken. That is all-time high on the energy trade for the record here, everybody. We've been in big consolidation in energy for a while, and it's because of the rally was substantial. Let me see if this put that on there. Yeah, this was like a multiple 100% up to the upside. We needed to consolidate for a very lengthy window there in energy. Okay, last one I wanted to hit on was healthcare because it's our secondary leader for the day. There's your weekly look. But Jeff, it's bouncing off of horizontal support. Once again, I'm reminded, short term, matching lows, totally cool, right? It's okay to have matching lows. It's the lower lows that cause us consternation.
Yeah, a little bit of a consolidation right here. I don't know that this is going to induce anybody to say, oh, this trade is over, but they're certainly going to be looking at this now. It'd be great for the bulls out there to reclaim and hold that 50 period and even get above that 20 period simple moving average. But really good call out, Kevin. You had higher highs. What you want to watch out for now are lower lows, and that just hasn't happened yet.
Exactly. And today could be a continuation candle for some if Friday was our low day, or if Thursday of last week was, or Wednesday of last week was the low day. We're already through the high of any of those 3 days. And so if that holds today, not only do you have the potential to close above the 50-day once more after a 3-day respite beneath it, you get back above the 50, you get a close above the high of the low day. Some traders are going to look at that as a potential entrance spot or the beginning of a continuation move. So this is nothing else. Tells a lot of traders under the white line, trend is different, or maybe there's greater risk, right? But we're not trading below the white line at this time. So just a heads up on how healthcare is acting, and a reminder that when we looked at this on this view, Jeff, this is precisely why it's imperative to look at this stuff, everyone, because the makeup and movement in this market is very different than what we've been seeing. It's not to suggest that we couldn't bring it all back, but when you look on a year-to-date basis and see that tech is laggard at 1% negative, when we've got energy up 12, materials 9, and staples up 8, this is a wonderful reminder that it is clearly a different market. Jeff, we've got a bunch of stocks in the news, so I'm going to throw a few up here. Some reminders of some companies you're all going to be familiar with. These are some big names. So I'm going to give you some upgrades to begin with, Jeff. Apple got upgraded at Phillips Securities to neutral, and they got upgraded to neutral with a new target at 260, which is up from 230. The firm citing strong growth in iPhone 17 sales and long-term monetization potential from Apple's collaboration with Gemini. Your thoughts on what you're seeing here? I'm going to move my detail out a little bit. I'll let you speak to the chart.
Sure. Well, you notice we have the earnings announcement. So that takes out a lot of the uncertainty that happens in stocks around this time of year. So you've got the uncertainty crush, or the implied volatility crush, as some would refer to that, going now to the top side. Okay, great. So we got some good information. We saw what we needed to see. We heard what we needed to hear. And now you're starting to move higher. Hopefully for the bulls out there, you see Apple get above that 50-period moving average and hold that. What might happen, though? keep an eye on the rest of the earnings. If weakness starts to get pervasive throughout the entire market as we go into like Google's announcement, if we look at AMD, if we look at some of those other folks, and they say, wait a second, this could really impact Apple, you may see a sideways trend going out for 3 or 4 months as we get to another earnings announcement. But in spite of that, always great for a company when they can get an upgrade from an analyst.
Absolutely. I mean, companies love those. The concern on the short run is that we've only bounced into a potential zone of resistance there. The red bar could be resistance, as could the 50-day. I renamed that at the 268 ledge, Jeff, because I think I think you're right. It's just as likely that we pop through 265 and test the 50-day when you're 2-3 points away. An intraday break would be all you need to pop to a 50-day moving average like that. So would not at all be a shock. We also got upgraded with a little company known as Microsoft. They've been under a lot of pressure. Software in general has been under pressure. And then Microsoft announced last week, and you can see that they broke down after a rally into the resistance zone there, the 200-day moving average. They're below all 3 major groups, 20, 50, and 200-day moving averages, I should say. They were upgraded at Philips as well to buy from previously at Accumulate. They put a new target here, an unchanged target at 540, Jeff.
Yeah, you've got that breakdown, and now you've got 1, 2. This is 3 days. You're holding below that. We'll call it the 450 level or so. That's a little bit of a concern if you're in the bull camp. The other thing to keep in mind on a fundamental basis, Kevin, the conversation around Microsoft is not the same as around Google or NVIDIA. Yes. Those companies are getting more of the innovative movement that we're trying to see from the tech sector. Whereas Microsoft, I don't want to knock on the company. I know it's very difficult to release a new product. Their Copilot just has not been what a lot of folks were really hoping from that. And so that's putting some more downward pressure from the fundamental side. Now what we're seeing is the technical side. So those are what's capturing my attention. Anything that you're seeing on the chart pointing out, I know that big drop could be of concern for a lot of traders out there.
I've got to pay attention to the gap zone, man. I drew in the green line right at the bottom of the gap, or the top of the gap, I guess it were, from the earnings in April of last year. Huge move, and now we just retreated to that. So, if nothing else, if you're an investor who says, hey, I feel like this is undervalued. We are a 555 all-time high. We're trading down 120 points, and you want to step in here, some traders would validate that. Other traders would say we're below all the moving averages. Why would I step in to a short-term downtrend or a trend that's not yet clear? One thing that is notable is that the selling has kind of started to run its course, right? We've been to this ledge 3 days. It's very important that it holds this level, but we know that there's some prices in here above which we can start to feel a little bit more enthusiastic or bullish. And it might just start with a move through the high we had from last Thursday. So, as always, know the levels where you want to take action, but under the green line, things get more risky for Microsoft. Above the white line, the short-term white line, you've got a potential for a short-term pop to the upside. Doesn't mean it's going to be the low of the period you're stepping into. It could easily just rally to the 20-day and lose steam. It could rally to the 50 and lose steam. It could rally to the 200 and lose steam. It could even rally to the 200 and move even higher. That's also possible. Sure. But have a plan, try to stick to it. That's really the key that we like to remind our traders about, Jeff.
Absolutely. Great call out, Kevin.
All right, I'm going to give you one more with another upgrade today as we wrap things up. How about Palantir? So Palantir got upgraded, and they were upgraded at William Blair, upgraded to outperform from previously at market perform. They did not set a price target on this. The firm citing valuation for the upgrade. That's the first time I've heard anything about positive valuation relative to Palantir. This one has made a pretty good pullback. You're looking at about, 57 points. So about a 25 or so pullback, 25% pullback to this zone right in here, 30% off the peak, Jeff. What are you seeing here at this point?
Well, that was one, again, what do we want to look at going back to the fundamentals? that was a company that had a PE that was just so darn high for an S&P 500 company that a lot of people were saying, hey, can it continue this momentum? I think this earnings announcement coming up will be the telltale sign. Do we pop or do we continue to drop? Now, seeing the fact that it lost that 200 period simple moving average, I don't know if that's the biggest concern. I really think the earnings announcement is going to be the driver and what happens to the fundamentals after that, Kevin. But right now, kind of like on Microsoft, if you're somebody getting into a bull trade, you've got a lot of upside resistance that you're potentially going to have to go against. You need to get past that 200, you need to get past the 20, you need to get past the 50. Very, very difficult if you're looking at a trade like this on a risk to reward basis. Keep in mind too, that earnings announcement is potentially going to be a very large mover. So if you're somebody that says, well, I'm speculating on the earnings play, nothing wrong with that. That's fine. Just know that it is a speculative trade. You usually want to allocate more money to the fundamentals, the bigger positions, the long-term things, and smaller money, Kevin, to the speculative play. So if you're going to take a speculative earnings play, by all means, enjoy that. Just know there is more risk, so you may want to allocate less asset.
Trade management 101 stuff, Jeff. More risk, fewer dollars, more comfort, more dollars, perhaps. So great stuff as always, man. Love having you on the show, Jeff. Thanks for being here, sharing your thoughts and your insights as always. We'll reconvene in about another 4 weeks to do this just again, but thanks for being here, buddy.
Looking forward to it. Thank you very much for having me.
As am I. And thanks to all of you for being here. Big thanks to Brent in the chat. Follow us on X, Brent Moore CS, Kevin Horner CS. Hit that thumbs up button for us if you like the discussion today. We're going to get this reviewed and into the archive for you as soon as possible. So have a great Monday, everybody. We look forward to seeing you again real soon.